Special purpose acquisition companies, known as SPACs, have become increasingly popular as a means to merge or acquire private companies and take them public, providing a range of advantages to both investors and companies. The COVID-19 crisis has exponentially accelerated the growth of SPACs as companies have been looking for alternative ways to raise capital. However, this has not been without concerns and criticism about accounting issues relating to the unique financial derivative, a warrant, which SPACs utilize. SPACs are companies that have no functioning business or assets, but are instead designed to raise money through an initial public offering (IPO), and then later use that money to merge with or acquire a private company, thus indirectly taking it public. SPACs are generally formed by investors, called sponsors, who have expertise in a particular industry with the intention of pursuing deals in that area. They raise money for the merger or acquisition by selling units which are often priced at $10 and are structured to offer investors one common share and a warrant or a partial warrant. A warrant is a contract that allows shareholders to buy a certain number of additional common stock at a certain price at some time in the future, often at a premium to the current stock price at the time the warrant is issued. These SPAC units trade similar to stocks on the exchange market, as investors can buy or sell their units at the current market value. The sponsors running the SPAC then have 18 to 24 months to buy a private company that they think has potential. Once shareholders approve the SPAC merger and all regulatory matters have been cleared, the merger will close and the target company becomes a public entity. If an acquisition isn't made, the SPAC will be dissolved and investors are entitled to receive a refund of its total capital proportional to their investment. If a target is identified and approved, the SPAC and the target company combine and begin trading publicly using the SPAC's ticket. This is known as the de-SPAC process. The SPAC will typically need to solicit shareholder approval for a merger and will prepare and file a proxy statement. This document will contain various matters seeking shareholder approval, including a description of the proposed merger as well as the financial information of the target company. As part of the de-SPAC process, shareholders can then decide whether to stay invested or withdraw their money, based on whether they believe it is a good investment for themselves. If shareholders then stay through the acquisition, then their investment will rise and fall with the share price of the company. In essence, this use of a SPAC is twofold. Investors want to see returns and private companies want to go public. The question is then, why would anyone want to use a SPAC instead of the more conventional and traditional IPO process?
There are various pros and cons of taking companies public through SPACs. The three most significant advantages of SPACs compared to traditional IPOs are their speed, the guaranteed acquisition price, and the ability to use forward-looking statements. An IPO can take anywhere between 12 to 24 months, whereas once a company has been selected, a SPAC merger only takes around 3 to 6 months due to the lighter regulatory processes. Speed is certainly preferable for most companies going public, as they can get on the market and gain access to capital much faster than they would with a traditional IPO. There is also more certainty with SPACs around a company's acquisition price, as it is decided through a privately negotiated merger transaction with the SPAC rather than with underwriters in an IPO who set a range with a valuation which can then move around depending on market conditions. Another significant advantage of SPACs is the option for private companies to use forward-looking statements to market themselves to the SPAC investors rather than the historical financial statements required by IPOs. This is beneficial for fast-growing companies without a long operating history who would be hindered by the financial statements required in an IPO prospectus. Despite the numerous benefits, there are many risks that come with going public with a SPAC. The most significant disadvantages of SPACs for private companies is the dilution of shares and regulatory expectations. SPAC sponsors can own up to 20% stake in the company through promotes, which allow them to issue new shares, thus increasing the float and causing dilution. Additionally, the warrants issued to initial investors in the SPAC, allowing them to buy stock at a fixed price, further increases the float and dilutes ownership. Another disadvantage for private companies going public through SPACs is that once the merger has been completed, the SEC does not grant the same grace periods for several areas of regulatory compliance as is done for public companies created through traditional IPOs. For example, SPACs are not given the 1-year annual grace period for internal control compliance integration for the target company. Private companies usually need 18 to 24 months to transform their functions and processes to fit with the regulatory expectations of public companies. the lack of underwriting services and compressed timeline afforded by using a SPAC can lead to issues down the track for the new public business. Overall, utilising SPACs to go public can be risky for private companies due to lack of regulatory processes and uncertainty with share dilution. Despite this, SPACs have been growing in popularity, and already this year, 330 SPACs have raised almost $105 billion. One of the most recent and successful SPACs has been DraftKings, a digital fantasy, sports, and iGaming group which closed up 10.1% at $19.35 after going public, which gave the company a value of $6.3 billion. Based on the aforementioned pros and cons, it can be seen that SPACs are suitable for fast-growing companies or mature private companies with well-placed operational and internal controls.
Now that we have an understanding of what a SPAC is, how it functions to take private companies public, and the pros and cons associated with its use, it's important to take a closer look at the current accounting practices used within SPACs. This is because, as previously alluded to, these practices have recently drawn some criticism from regulators, investors, and members of the public. The fundamental accounting differences that a SPAC deals with regards to warrants it is issued to shareholders alongside common stock at the IPO. The warrants are a contract which allow the holder to purchase shares for a fixed strike price in the future. These are an attractive option to investors in the SPAC, as if all goes to plan and the merger is successful, the strike price will most likely be below the market price the shares would be trading at, thus offering a greater yield to investors in reward for their risk. Whilst one would expect a warrant to be treated in kind to other financial derivatives when it comes to accounting, this is not the case. Unlike most financial derivatives, for example, options, forwards, or futures, which are accounted for under liabilities on a balance sheet, current practices amongst SPACs is to account for warrants by showing them under equity. But where do warrants actually belong? As liabilities with other derivatives, where they are held at fair value with changes in fair value hitting earnings each period, or in equity with common stock, where they are held at purchase price. Currently, as with all financial derivatives, GAAP says it depends on some key criteria which look at the legal construction of the warrant itself. Current practice among SPACs is to draft the legal contract of the warrant such that it includes clauses in the order to meet the requirements to be classified as equity. Achieving this equity classification is highly preferable in the eyes of SPACs, as by doing so, they get to realize several advantages. Firstly, they save on operating expenses by not needing to pay accountants and valuation experts to try and measure the fair value of the warrants. Secondly, they get to eliminate the variability of the changes in fair value from hitting the income statement, thus establishing profit. And lastly, they get to present a stronger and more attractive financial position to investors by showing fewer liabilities. Given it is clearly advantageous for SPACs to classify warrants as equity, there has been recent scrutiny about whether the clauses included in the warrant contract actually do meet the criteria set out in GAAP.
Specifically, the SEC has outlined two GAAP criteria causing accounting issues: indexation and tender offer provisions. The requirement for indexation states that for a warrant to be equity, it must be indexed to the SPAC stock price. In determining this, the number of shares available for purchase under the warrant and their strike price is examined. To demonstrate, if the warrant is fixed for fixed, meaning that a fixed number of shares, say 100, are available for a fixed price of, say, $10, then the warrant is considered indexed. Notably, a warrant can still be considered indexed even if it violates this fixed for fixed rule, so long as the settlement price is only allowed to change as a result of something listed by GAAP as a standard input. The SEC noted this exception is one of the main areas warrants are misclassified. Many SPAC warrants allow changes in the settlement price by factors that aren't approved by GAAP as a standard input. A common example is if a warrant becomes non-redeemable because of the person holding it, as the holder of the warrant is not listed as a standard input. Therefore, warrants containing a clause like this, and this is a common clause within SPAC warrants, they fail to meet the indexation criteria and therefore must be classified as liabilities. Tender offer provisions is the second criteria. Essentially, it states that if a clause in the warrant allows an event outside the SPAC's control to require net cash settlement, the warrant is not equity. However, an exception exists which states if the event is outside the SPAC's control and changes the ownership of the SPAC, and the net cash settlement results in shareholders also receiving cash, then the warrant is equity. This exception is where the accounting issue lay. A common clause in warrants is that if a tender offer is made to and accepted by a majority of a single class of shareholders, all holders of the warrants and the shares are entitled to cash settlement instead of share settlement. This clearly is an event outside the SPAC's control, since shareholders decide the outcome, not the SPAC itself. Thus, the exception is relied upon to gain equity classification. However, the SEC has said that since only a single class of shareholders are voting, then that does not necessarily qualify as a change in control of the SPAC. This is because even if 50% of a class of shareholders vote for something, that class considered holistically may not even have enough shares in the SPAC to have or change control. For example, suppose the SPAC had two classes of ordinary shares, A who hold 60% and B who hold 40%. If the warrant requires the vote of Class B shares, then clearly that doesn't change control of the SPAC, since even if all 100% of B vote in favor, they still only make up 40% of the total shares in the SPAC. Thus, the exception of change in control is not met. These issues identified by the SEC lead to further accounting issues. The whole purpose of producing financial statements is to provide fair and reliable information that meets the needs of users, namely investors, such that they can make informed decisions. If users rely on these misstated financial statements, which wrongly classify warrants, they could miss potential warning signs of financial distress and make adverse financial decisions. Further, by producing such statements, the SPACs jeopardize the integrity of not only themselves as an industry, but also the very nature of financial reports and accounting.
So let's further consider whether the SEC's concerns are ultimately valid and whether they're material enough to instigate changes to current accounting practice. To reiterate, SPACs have surged in popularity over the past 2 years, raising more capital in the first quarter of 2021 than the combined $83.4 billion raised in the entirety of 2020, as the graph indicates. Now, given this recent surge in popularity and the subsequent high levels of capital being transacted in the SPAC market every day, the SEC's concerns regarding the disclosure of warrants are certainly very valid. The public should be empowered to make informed investment and voting decisions, as this is fundamental to a healthy and stable economy. And as Anjali has previously noted, SPACs can already be quite risky due to their lighter regulatory processes and their often rushed financial statement preparation procedures. So strict disclosure principles must be adhered to. Therefore, in line with the principles of faithful representation, to maintain high standards of disclosure and integrity in financial statements, current accounting practice should change so that warrants are classified as liabilities when they do not meet US GAAP requirements to be classified as equity. Although it must be noted that SPACs in the past have twice already faced the need to reclassify warrants from equity instruments to contingent liabilities. First in 2006, second in 2013, and now for a third time in 2021, for essentially the same exact reasons. And in those prior two cases, the market seemed to shrug off the changes, fundamentally because new SPACs simply revised their warrant agreements to eliminate the clauses that were resulting in a liability classification. Accordingly, it's not enough for the SEC to just voice their concerns and mount public pressure for SPACs to change their accounting practices, because as history shows, the market will most likely shrug off the changes as immaterial and not share the SEC's concerns. It follows that if the SEC wishes to promote lasting change, it should use its influence as one of the key economic regulators within the US to advise the Financial Accounting Standards Board, the FASB, to tighten US GAAP standards so that there are less exemptions for warrants to be classified as equity, or at least revise the wording of those exemptions. Otherwise, there will continually be a game of cat and mouse between SPACs and the SEC. In summary, Special purpose acquisition companies are companies with no real commercial operations that are formed strictly to raise capital through IPOs and acquire existing companies. They represent an alternative to the more traditional IPO process of taking a company public, and so there exists several key distinctions between the two. One of them, as we've highlighted throughout this presentation, is how SPACs classify warrants on their balance sheet. The SEC has recently voiced their concerns that many of the common clauses within warrants point to them being classified as liabilities in line with US GAAP. However, many SPACs have instead been classifying them as equity. The SEC's concerns are very valid because it is their job to enforce strict disclosure principles, and so current accounting practice should change to reflect this. And to avoid SPACs from simply revising warrant clauses to allow an equity classification, as they have done so numerous times in the past, the FASB should actually tighten US GAAP standards, revising the wording of key exemptions being taken advantage of. Thank you very much.